Hello everyone, this is Daniel. Today we will be talking about capital management, which is also known as um, money management in financial markets. We are going to be talking about only two important things. Number one is rules that we follow in order to make sure that our funds are well managed in the market, and number two is trading plan. These are things which can help you to protect your funds, your capital, and they can help you grow. Now, let's start from rules. These are rules for installing stop loss. Why do we want to start from stop loss? It's because it's all about protection. It's either you are moving forward or you're moving backward. And what we don't want is to move backward because that is not a progress. So now, stop loss is something that is going to help you through this. Now, there are rules regarding stop loss we want us to understand because they're really essential for the success of money management in forex trading or in everything else in regarding financial markets. Now, rule number one, do not trade without stop loss. Stop loss help us to protect our funds not being ruined in the market, and regardless of how you can believe the analysis you made, or regardless of how sure you are that the market is going to go your way, you need stop loss. That is important because anything can happen in the market anytime, so you don't want to be um, a victim of these things which can happen anytime in the market. Number two, stop loss should not be more than 5 to 10% of your deposit. What do I mean by this? The universal rule says that per position you don't have to exceed 2% risk of your deposit or your balance. Here, what you need to know is that you need not to exceed five positions, and because you see when it's 2 times 5 and now it's 10%, so you don't have to exceed this. That's rule number two. Rule number three, stop loss is set per level, preferably for price noise, about 10 to 20 points behind them. um, this means that there is this place where the market is moving and back, but it's not showing a visible movement. Now you need to see this place and move 10 to 20 points behind that place. Now, because the task of stop loss is to minimize risk, not to be hurt by the slightest fluctuation in the market. So the closer you can move, put it next to this price noise, the higher risk of being caught by the price movement. Number four, do not transfer or move your stop loss to the negative zone. Now, this is something people do because of greed, and they are trading and they see that the price is going against them, and they decide to say, let me move my stop loss a little bit because it is going to move up again. The moment you do this, you are triggering your psychology to keep doing this and this. It works like a gambling. So we tell the rule is do not move it until your stop loss can be triggered. This is the business where you are sure about how much you are willing to lose or how much you are willing to make. So do not close the deal until stop loss is triggered, which is rule number five. So number six, move stop loss to the positive zone after transaction reaches on a certain position in a positive direction by approximately 30 points. You can completely remove the risk from it by moving stop loss to the opening price of your transaction. Now, this helps you to break even. Like, even if it can go against you, you are not losing any amount of money in this trade. Now, number seven, ratio of stop loss to take profit is either 1 to 2 or 1 to 3. That is, the mortgage risk should be 2 to 3 times less than the planned profit. You can follow the simple mathematical example we have down here. 10 transaction minus unprofitable at a stop loss 30 points to minus, it's like 1 minus 1800 to ratio of 4 profitable at a take profit of 60 pips, which gives us 2400. So now these are rules we need to follow. Always make sure that these rules are in place and follow them. You will reduce the risk of being hurt by the market. With the keeping the rules, this is one of ways you can keep yourself in a positive progress. Now, plan. Plan. This is one of essential tools that we need in order to protect our investment in the financial market, because it is said that when you don't know where you are going, every place where you are, you can confuse it as your destination. So it is important to have a plan in the place before you do anything else. Now, these are things we need to do on our plan. Number one is the date and the currency pair. You need to write down the date and the currency pair you are going to be trading. This is going to help you in the future because, as it is proven, the market moves in circles. Something that is happening today, it happened before, and it is going to happen in the future. When you record this plan and keep it safely, it's going to help you in the future decision making. Number two is direction of the price. You need to make sure that you know where the price is and write it down. B is price location. Now, where is the position of a price at this moment? You need to write it down. Then you have to write what does the filters are indicating, RSI or MACDs or any other tool that can show you the direction of the price. You need to record this. Number three, fundamental data. Here we're talking about economic calendar. There are different things which happen in economic world which can affect the pair that you are trading. So now in the future we will show you how to find these events, and we will teach you how to measure their intensity. Now you need to make sure that there is nothing that is going to affect the the decision that you are making today. Number four is the transaction parameters. You need to record entry price, stop loss, and take profit. And then number five, describe asset behavior scenario. Psychology, like according to you, how do you see the market is doing? Does the price going so very fast? Do you see high volatility in the market? You need to write down all these things because they are going to help you in the future. And also, this is a plan that you're going to follow. Once you have written these things, you know where the entry, you know the stop loss, you know take a profit. You don't have to do anything but to follow your plan. Then point number six, number seven comes after you have traded already. Because this is how now you know maybe you made any mistake, there is an error, you need to write them down because now they are going to help you in the future. That's why I kept talking about recording. These are tools which will help you in a decision making for the future time. Number seven is trading conclusion. Now you see what happened in the market generally, and you have to look at this and summarize the conclusion of what it looked like for this trading day or trading session. This is it for today, and we encourage you to subscribe and click the notification button. I wish you a wonderful day. This is Daniel. See you soon in future classes.